The Rebel Capitalist Show.
All right, guys, it gives me a great deal of pleasure to welcome someone back to the Rebel Capitalist Show. She is my good friend and one of my amazing partners in Rebel Capitalist Pro. Her name is Lyn Alden. Lynn, welcome back to the Rebel Capitalist Show, my friend.
Hey, thanks for having me back. Glad to be here.
Now, there is a lot going on in the world today, to say the least. So why don't you get everyone up to speed as far as what your macro outlook is right now for like the next 6 months, the next year?
Yeah, so the next few months, the things I'm going to be watching are the base effects. And so if you take a step back, over the past year, we've had, pretty much the biggest economic shock, since the 1940s in many ways. I mean, since 1930s, Great Depression era. And then we've had the strongest fiscal response since the 1940s. And so we've had that two extremes playing against each other. And so I've described it as like a control system where it shoots one way, but then it kind of pulls the other way, and then it's trying to find like an equilibrium around something that's closer to normal, less extreme. No negative oil or other kind of wacky things happening. It's kind of trying to get back to some semblance of normality, as close as it can in this environment with so much going on. And so we had, for example, if you look in 2020, we had a period where tech stocks and growth stocks pretty much were the only thing going up, and all the cyclical stuff was just beaten down. But then as we got kind of later in the year, some of that fiscal started taking effect. Then we got the vaccine announcements, things like that. We started to get an uptick in those cyclical names, so people kind of flocked back into those things that have underperformed and pulled some of them up. And so now, there's fewer cheap things than there were, say, 6 to 8 months ago. And so the next thing as I'm watching here are the base effects. But what I mean by that is that, if you look at most data, it's reported year over year. And so, in a given month, you're looking at the same month from a year ago.
Right.
And sometimes you have hard base effects, like you could have had a high month in say, official CPI measures, relative to the months around it. And so your year over year comparison is up against a tougher hurdle. And people can debate, of course, how useful those metrics even are. But if we're, because a lot of market participants do watch a lot of those metrics, it's important to keep in mind the base effects. And so if you look back in 2020, we had a period of low CPI prints. It started in March, but really it was April and May where you got the bottom of that data, the way they measure it. And so when you go forward into April and May of this year, which are reported with a lag, so they're reported in May and June, you're going to get a pretty substantial base effect. And so you're likely to get, say, a 3% official CPI print or more, even using their data on that year-over-year basis. And it's going to be interesting to see how the bond market responds to that, if it's going to look through it and kind of stick with the transient inflation narrative, or if it's going to get a little bit spooked and kind of, have another leg higher in yields. We're also going to see that in other economic data. And so whether it's, consumer spending, construction spending, all sorts of kind of, year-over-year economic data, a lot of the bottoms were in April and May. And so they're going to have some pretty big jumps in April, May of this year. And the same thing's going to happen with things that are reported quarterly, like GDP or corporate earnings. Quarter two was their bottom. And so quarter two will be some surprising year-over-year numbers. And those don't get reported until early, Q3. And so as we kind of, push through the summer, that's going to be kind of the narratives going around, is people are going to be sharing these wacky numbers that are happening. But it's important to kind of take a step back and look at, say, the month-over-month data to see what some of the things are happening, or to look at, say, 2-year average data and kind of, look past some of these base effects when you're trying to establish what is actually, persistent. So if we get, for example, a little bit of an inflation spike, we have to look past that and see what is actually the month-over-month data doing, and kind of have, that gives us a better indication of what's kind of happening in the real economy.
Yeah, a lot of the headlines I'm seeing right now that I've talked about on the Rebel Capitalist channel is that every single time you turn on the news, you see that the economy is booming. The economy's on fire. We have the best economy in human history of all time, according to GDP, 10% GDP growth. So why don't you walk the viewer through how they're coming to those conclusions, and if it has anything to do with the interpretation of the data?
Yeah, it's mainly like it's coming off strong of a very low base.
Right.
And so when we had like the biggest decline in GDP in modern history, because of the shutdowns and all this kind of ceased activity. Pretty much, restaurants were shut down and hotels were shut down and materials, all sorts of things were disrupted, especially the services sector. But really, a lot of different things were impacted. Of course, energy, people weren't driving, people weren't flying, people weren't taking cruise ships anymore, and so energy usage, declined, and so we had a lot of earnings problems in the energy markets. A lot of people lost their jobs, some temporary workers, some permanent workers, and so we had a really big hole that we fell into. And then they over time you pulled out of it as lockdowns eased, as people got a lot of money in their pocket from stimulus and things like that, and so you kind of go up in nominal terms, and you get that big gap, that big year-over-year gap, because you're comparing to low base effects, but you're still below the trend line that you would have been, say, the beginning of 2020 before all this started. Right. And so you're still below trend. So if you look at, say, the 2-year, average GDP growth, it's terrible, whereas that year-over-year growth is very high. Another way to look at it is that, if you look at the Wilshire, equity index, which is, basically the combination of large caps and small caps, it measures most of the U.S. stock market capitalization. That actually had the biggest year-over-year percent increase in history from March 2020 to March 2021. Even though it was a pretty strong stock market, but it really wasn't anything special. But when you're comparing that specific 12-month period, you're comparing it like we went straight down in March, and then we bounced back really hard, and so you're comparing that, you're getting like 80% year-over-year increase, whereas if you back up and say a 2-year average, it's not as spectacular as that specific 12-month period due to the base effects.
Yeah, and it's similar with the ISM too, when they're just pairing it. So the media is basically cherry picking whatever narrative they want you to believe. Either the economy is terrible, or the unemployment levels are terrible, we're all doomed, so therefore we need more stimulus. Or don't worry about it, the economy is great, it's the best booming economy of all time that we've ever seen, just based on what day it is, or maybe what hour it is. I pull up my news feed, and it's just, one thing is we need more, like one headline will be we need more stimulus because everyone's hurting right now. Then the very next headline will be like economy is booming by 30% this year. And you're like, okay, well, which one is it, right? But hopefully that will shed some insight for the viewer as to why they're seeing such wildly different types of headlines. So what headlines do you think they should believe? Are we in an economy right now where unemployment levels are extremely high and it's very tenuous? It's kind of month by month, let's see how it goes. Or should we be very, very optimistic and positive because of a vaccine or whatever other reason?
It's somewhat mixed. It really kind of comes down to what sector you're looking at and more specific kind of niches of the economy, rather than taking the whole economy. And so, one way you can use those headlines and numbers in general is to compare different countries. And so, all of them have those base effects, but some of them came off those low bases faster than others, partially because they did stimulus and therefore devalued their currency more. And so in measured in those currency terms, they've done quite well. And so there's a bunch of different ways to look at it. And so we are seeing, for example, that the United States is coming out of it stronger than Europe, for example, because they're still in many ways doing longer shutdowns. They've had, more of an issue with getting vaccines to the people that are more vulnerable to the virus, like, the older populations. And there's all sorts of reasons why that's the case. But so like kind of relative comparisons are useful. And you can also compare which sectors are, jumping back faster than others. And so, for example, because people got stimulus, retail spending hit new highs, pretty early on in this recovery. And so that was something that even compared to the trend line was doing pretty well, whereas other areas like energy usage were more depressed because people weren't driving. They were staying home and buying on Amazon, for example. And so there's that kind of sector by sector difference. There's also a case where, depending on what kind of class you're in, I guess you could call it, the economy is either booming for you or really hurting for you. And so if you lost your job and you're kind of relying every few months on stimulus checks and unemployment benefits, the economy is really weak in that regard. We still have below trend employment. We still have all these issues. Or on the other hand, if people didn't lose their jobs and they work in something, they can work from home, or they have multiple income streams or whatever the case may be, they're doing quite well. Especially if you're in the upper 10%, let's say, of the income spectrum. And so we kind of have multiple different economies depending on what sector you're looking at and what kind of work you do. And I think that's kind of why we're getting really weird, conflicting headlines between a booming economy and also pointing out how many people are still struggling, because that's really the case. I mean, many of the nominal GDP numbers, especially in year-over-year terms, especially compared to how we were a year ago, are up a lot, but still below trend in many cases, whereas many other people, didn't really rebound in the same way. And so that's where you're going to get that conflicting stuff.
Yeah, I want to go back just a little bit when you say they're doing well, and I want to unpack that just a little bit, because I was in Tucson over the last few weeks, and you have this just bizarre juxtaposition where if you're downtown, everything is boarded up, all the businesses are closed, there's no more students. I mean, it used to be an extremely vibrant area. Now it's a complete ghost town. When I was there in the past, it was 5 minutes at the most to get an Uber, at the absolute maximum. Now, 45 minutes, if you're lucky. It's almost impossible to get an Uber. In fact, I missed my COVID test to go to Puerto Rico because I literally could not get an Uber. I had to reschedule it for the next day. This is a true story. I had to reschedule it the next day, because you have to take it within that 72-hour window.
Yeah.
But yet it takes you up to 48 hours to get the results. So there's a very limited time frame in which you can take it. So I had to schedule it first thing in the morning the very next day, and then hope to get. I still couldn't get an Uber, so I had to jog. No, this is a true story. I had to jog 4 miles to go get the test and jog back because I had an interview with Mark Faber that I had to get to. But yet I set up my appointment at like 9 a.m. I had to get to the interview at 10 a.m. So I had to jog there 4 miles, jog back. But when I got there, they wouldn't give me the test because I didn't go in a car. But literally, I was standing there 3 feet from the gal, and she wouldn't give me the test because she said I needed to go through the drive-through. I'm like, okay, well, I'll just walk through the drive-through. No, you can't. You have to be in a car. I mean,
Jeez.
so my point is this. Here's I had a point with that story, and that's that although some people's bank account, like my bank account, your bank account, we might be doing better in that sense because our asset values are increasing, but are we doing better in the sense that there's no more goods and services? Like you could be the richest person on the planet Earth, but if you're in an environment where the amount of goods and services you have access to are decreasing, then are we richer? And then that takes me to my next question for you, which is all about the supply chains. And that takes us to inflation, deflation. I'm seeing that the supply of stuff, like I said, is decreasing dramatically. Every time I go to a restaurant now, or at least when I was in Arizona, when I was in Park City with Ken, it's a 2-hour wait to get to restaurants that used to be just 10 minutes because of a reduced capacity, because those restaurants closed, they're never coming back. Therefore, now there are fewer options and fewer restaurants have started as a result. So how do you put all of these pieces of the puzzle together to try to figure out what consumer prices will do long term, and therefore maybe bonds and therefore stocks?
It's a really good question, and it's certainly a different way of measuring it. And so, like you said, people can be doing well financially, but they can't necessarily do the things that they want to do as easily. And I've noticed too that restaurant times are up a lot because you still have maybe you have 90% of people that still want to eat there, but you have half the capacity, and so you have those longer wait times. And that Uber story is crazy. I mean, I actually haven't taken an Uber in probably a year now, just because I haven't really been traveling much, and so. Same thing, like I basically had to skip or delay certain trips that I was planning on taking just to avoid kind of the hassle of unnecessary travel during a time when you have to wear masks on an airplane, when basically you run into issues like you described. And so it's certainly kind of decreased supplies and services. There's also a case, we have the classic like paper towel shortage or the toilet paper shortage that
Right.
keeps coming up in kind of these waves of shortages. And there are times where the store is out and people willingly pay more to get them, but they're just not there. And
Yeah.
so,
And I read this morning, Lynn, that the car manufacturers are still having an extremely difficult time getting,
Semiconductors. Yeah.
yeah, is that what it is? And therefore,
Yeah.
how does that affect supply? How does it affect prices?
Yeah, there's semiconductor shortages because a lot of them are made in Taiwan now. There's really it's kind of amazing. Most semiconductors are made in a few countries, and so Taiwan and South Korea control a very disproportionate percentage, especially high-end semiconductors, and so there's shortages for a lot of multiple things. I mean, literally anything ranging from cars to Bitcoin mining equipment has trouble getting semiconductors. And so that it's particularly impacting the car industry because you have this $30,000 product that's tied up due to $1,000 in chips that it
Right.
can't source correctly
Why can't they get the chips?
because there's limited foundry capacity in say Taiwan, and those foundries are very expensive to build, and so they're actually just maxed out. They're just kind of being fully used. I think it's because there's been an influx in consumer electronic buying during this period. There's been all sorts of kind of limitations, and so they basically those foundries are kind of just tapped out for like 6 months, saying that, and then they prioritize, their customers where they can. And so if something like a car manufacturer is actually pretty high in line. I mean,
Right.
they have they have a lot of priority over a smaller thing, and even them, they're having trouble getting all the supplies they need, because
If
you have
the car manufacturers aren't getting them, think about how many other smaller manufacturers aren't getting them and how that affects their ability to create goods.
Yep, exactly. And so if you look at the inflation, kind of how that impacts inflation, we've had this disinflationary environment over the past 40 years, and it's due to a variety of factors. But one of them is the increased efficiency of supply chains. But of course, that came with cost. That came with increased fragility. It also came with, outsourcing, say high quality blue collar jobs in the United States, and then they're moved over to China where they're paid, a tenth as much. And so we have that kind of global arbitrage that happened over the past several decades, and that might be running its course. And so, for example, if you look at global trade as a percentage of global GDP, that was strongly rising for a long time, but then it peaked in 2008, and then it's been like choppy and sideways since then. So it's not really reversing, but globalization is not really accelerating like it used to be. And we've kind of hit that period. We might have hit kind of peak globalization, and now there's more realization, especially from COVID, that that had a trade-off. That we have, that's part of the reason why we have wide income disparities in some countries. It's part of the reason why we can't get basic supplies and goods because only like this other country makes it, and so we have to wait for the the ships to come, and you have to make sure that there's no kind of extra capacity. Everything's kind of optimized for the quarterly result. Everything's optimized for the absolute minimum cost and maximum efficiency without really a mind towards resiliency. And so if we do get a trend towards increased domestication of various products and services, that can increase resiliency, which is a good thing, but it does come with higher costs. And then when you take a step back and you look at the broad money supply, which is very different than the base money supply. So different than just bank reserves, different than all
Right.
the money that gets locked in the system, but looking at actual broad money supply, which is checking accounts, savings accounts, currency in circulation, we've had the sharpest rise since World War II in a year-over-year terms. And that's not even due to low base effects. That just, it was already going up and then it just jumped tremendously.
Yep.
And it's still going up at a somewhat accelerated rate, even though it's not going up at the same rate that it was, in the heart of 2020. And historically, broad money supply increases are strongly correlated eventually with consumer price increases. And one way I like to put it is a lot of people debate about what inflation is, what definitions we should use, and sometimes you have people talking past each other. And so what I like to do is just separate the terms and just describe what type of inflation we're getting. And so if you get a sharp rise in broad money supply, that is by definition monetary inflation. You're getting that sort of inflation. But then the question is, where does that money flow into? What sort of prices does that prop up? And the answer tends to be whatever is scarce. And so if you get a lot of money that especially pools in the upper classes, what's scarce is financial assets. So things like stocks, gold, fine wine, high-end real estate, Bitcoin, whatever people want to store their money in other than cash that's not keeping up with inflation will be bid up in price. On the other hand, if you were to get, say commodity shortages, if you were to get, kind of a broad rise in wages, if you were to get a broad rise in even just consumer incomes that are not necessarily from wages, it could be just due to stimulus checks and things like that, and people are able to spend more, and you kind of get that increased demand relative to tight supply for whatever reason, then you can get that increase in consumer prices. And so for the past 10 years in particular, we've seen that we've seen the asset prices take most of that, especially in 2020, because people's demand was reduced because we mainly saw CPI stay low and asset prices go up. But now as we encounter these low base effects, and then as we hopefully globally come out of these lockdowns, there's more demand for those goods at a time when a lot of them do have pretty stuffed checking accounts at this point, and so that's where you can get those inflation spikes, because you're chasing this shortage of goods with a decent amount of money to buy them, and so people are willing to pay pretty high prices to get things that they really want. And so, for example, if people haven't taken a vacation, and they've saved up some money, they're willing to pay more for like the same vacation than they might have otherwise paid, because they still want one and they still have some extra money, and they're like, well, I don't care if flights are 20% more expensive, or if the hotel is 20% more expensive, or if the restaurant is 20% more expensive. They're like, well, I still want to do it. And so that's where you can get those substantial inflation.
Yeah, so what I'm thinking through when you're saying that is M2 is up. It's there in partly because incomes are up, and that's on a baseline, or what's the right word? Even going back to 2019, incomes are up higher than they were in 2019. It's not like we're coming from a low base.
Yes.
And that's with extremely high unemployment. So we're talking about the goods being manufactured in the United States. So all those companies and entrepreneurs have to set up shop here to create those goods domestically. At the same time, you have incomes up, let's say 20 or 30% since compared to where they were in 2019. So you have those entrepreneurs competing against the government for those workers to create the goods that we need to produce domestically. So what does that do to wages? Because the entrepreneur is going to have to increasingly put out more and more and more as far as payroll in order to attract those individuals away from the government. There's that competition there. So how does that affect consumer prices?
Yeah, and it's partially going to depend on what those corporations feel like they can pass through to their customers. And so as they increase wages, then they have the option of either reducing their own profit margins, because say they feel that demand's going to be kind of weak and they can't pass on the prices to consumers, and they don't really have a choice to pay higher wages, so they have to pay those to attract the right employees. But then if they have trouble passing those costs on to consumers, then their margins get squeezed. On the other hand, if they are able to pass through those cost increases to consumers, then that's where you get a broad rise in prices. And as an anecdotal example, we replaced our mattress. It basically had like an issue with it, and we had like a kind of a warranty thing. You can get the same mattress, and you just pay the difference of cost of how the price changed, and it was up 20% in like a 13-month period. It was like a little over a year. It was up 20% for the same mattress. And that's not, you don't see that kind of thing in CPI. And another way to look at CPI is that a big chunk of the CPI is basically the way that they calculate your rent, or your equivalent owner's equivalent rent. And so because you're in major cities, like you mentioned, cities boarded up and things like that, we've had a decline in rents and prices in some of those cities. And we've also had all sorts of moratoriums on removing people from properties for not paying rent and things like that. And so that's kind of weighed down some of the broad indices, while other things have gone up. And so you've had that kind of balancing act. So if you were to get those declines were to stop happening at the same time as those individual consumer prices are still going up, that's when you can start to get an uptick in even some of those official CPI measures, let alone the fact that people can calculate their own basket of inflation. Because not, you don't purchase the same things I purchase. We, especially, if you look at, say, someone with a family, they have 3 kids, they're going to be purchasing very different things than someone who has no kids. Or so basically what sort of lifestyle you live really affects kind of what your inflation basket looks like. And people can calculate their own inflation basket and start to see that likely they're going to begin going up if they haven't already, throughout kind of as we get later into 2021.
Yeah, we talk about incomes going up all the time, the us macro geeks, but oftentimes we forget that expenses have been maybe cut in half because most people don't have to pay rent. They haven't been paying their mortgage, and that's the biggest chunk of most people's uh, profit and loss, let's say, or their expenses. Um, and so you increase incomes, you decrease expenses, you got a lot more purchasing power. And I think a lot of people would say, all right, well, the United States has done better because they have done stimulus. And I think in the short term that's true, absolutely. But I always think, what does this do to the economy in the long term? And what type of distortions are we creating right now that are going to potentially affect the economy in the future? And we talked about Uber, we talked about all of your mattress is going up by 20%. You can't get a reservation at a restaurant. The government is paying people to stay home. Entrepreneurs are now having to compete with the government. I mean, what does that do longer term? I mean, I'm thinking 5 years, 10 years down the road. Or is that an economic question that really should be a political question?
So that's one of those things where economics and politics start to blend, and
Yeah.
people kind of mix their own ideologies into it, and it gets really complex to kind of sort out what is true and what is not. The way I put it is, it really kind of depends on the effectiveness of that spending, and so if that money goes towards infrastructure projects, if that money goes, high quality, like needed infrastructure projects, not kind of the bridges to nowhere thing, but for example, one of the most economically powerful things in United States history was the interstate highway system, which was put in place, under the Eisenhower administration. And so that was one of the largest public works projects in history. But that was extremely accretive to value because it boosted the productivity of the country so much. So that was an example of a high quality infrastructure project. Whereas if you were just kind of building, if you're kind of doing the common saying of you're digging holes and filling them back up, that's not producing long-term productivity. And so if money goes into, better internet speeds, better, fixing crumbling infrastructure, things like that, that could be accretive to longer term GDP. On the other hand, if it gets wasted, if it gets kind of squirreled away to things that are not very effective, that's when you start to get, potentially inflation, because you've increased the broad money supply a lot, but you haven't increased the availability of products and services. You haven't increased productivity by a corresponding amount. And so it really kind of depends on how that gets spent over time. Now, the spikes we've seen from broad money supply due to stimulus checks, they mostly offset that big deflationary shock. And so if you looked at, say incomes, for example, you saw, you have a trend line. And so most recessions, you go below trend, then eventually you come back up to roughly where the trend was. Now, this recession was different because of the large fiscal response. And so we saw periods where incomes spiked above trend. Then as there's like periods of no stimulus, like say between March of 2020 and then kind of the autumn period where they did another round. So from there you had kind of you went back to trend, and you kind of were roughly back at trend again because you had that offset where the stimulus was wearing off, but also people lost their jobs, and so you had that kind of you're back at trend. But then they did more rounds of stimulus, and so it's really kind of about keeping it above trend is what they're doing rather than just kind of keeping it at trend. And so we'll see how this plays out. The challenging thing from a political perspective is that back in 2008, the banks got bailed out, but the broad public didn't get bailed out. And so they're not going to accept the idea that they're not going to get bailed out this time. And so that's where you have that dynamic where they set up one incentive, and so they have to kind of do the opposite now. And so we'll see how it plays out. But over time, that is one of the risks to be aware of, that as you increase the broad money supply this much, you do get inflation most likely. So basically, you better make sure that those funds are spent in a productive way that actually increases products and services.
Yeah, so if I'm hearing you correctly, there's going to be a lot of political pressure to continue the stimulus, just sending people checks, UBI, whatever you want to call it. Whether that's a bailout or I think they've already been bailed out because they're making a ton more money now than they used to on aggregate total. I know there's pockets of people who are really hurting, but so if you have the government in the mix there, and they continue to send out checks, aren't we at risk of building an economy around stimulus, and therefore we have to have it? To me, it seems like QE. Remember, when Ben Bernanke did QE, it wasn't QE1, it was just QE, because they said that we wouldn't need 2, 3, 4, and now infinity. And I mean, if we get the same thing with stimulus, I mean, can we ever pull that back, or do we just continue to have to add more and more and more stimulus?
Yeah, that could be very hard to pull back. I think the limiter there is if you were to get, kind of unavoidable inflation. And so now we're kind of in the period where we're all debating about how high inflation is. So some of us are pointing out to our 20% mattress year-over-year increases. Other people are saying no, CPI is still below 2. And everyone's kind of debating, how much CPI there is, how much inflation there is. Now, if you were to get a period where you have unmistakable inflation, that's the thing that kind of puts the brake on fiscal policymakers' ability to keep doing that. And so that's when you get those really hard choices where they're kind of forced to pull back. Otherwise, they could lead to a potentially very inflationary outcome. And so basically that's why I'm watching these base effects so much, to see, we're going to get these like kind of brief inflation spikes just because of the base effects, and then we got to see how persistent that is. And so if, say, the deflationists are correct, and like the debt, the technology, all these other things kind of overwhelm the inflationary response, well, that gives policymakers more incentive to do it again, because they basically were able to, send everyone checks and not really get the bill for it, in a matter of speaking. On the other hand, if the inflationists end up being correct and think that, okay, this is probably enough to kind of trigger a more structural change in inflation, well, that kind of starts putting brakes on the policymakers' ability to keep doing that. And I think, as you look at different types of stimulus or aid, I think there are different ones that are more effective than others. And so one of the things I would have liked to have seen, for example, is a reduction in payroll taxes if they want to keep stimulating kind of the working class, because that allows them to keep more of the paycheck they otherwise would have gotten. It also, if you do that for the employer side, then it makes it cheaper for them to hire people, because they're paying kind of a smaller percentage, from hiring people.
Right.
And so I think that's one where it would have been nice to see maybe some workaround there, because that can let people keep more of a check without kind of having that competing force of you're getting stimulus check, but then a private sector is offering a job. That makes it just basically more cost effective to have a job and more cost effective to hire people. And so people can debate about what the best levers to pull are. And those are things I'm watching as we go forward to see, how it would affect my inflation versus deflation outlook, to see, what is the magnitude of the spending, and also where is it going, who's it going to, is it increasing productivity, things like that.
Do you think we get into a scenario where the politicians want to continue with UBI because they're buying votes, and it's very popular with the people, but yet we get to a point where we see this increasing inflation, let's say 1970s type of inflation, so they have to do something. Do you think the first plan of attack will be to continue with UBI but yet set up price controls?
I think that it depends on when that comes and who's in power when that happens. And there's a couple different levers they can pull. So, for example, we're looking at the latest infrastructure proposal. They proposed increasing corporate taxes back up to the halfway point, from the Trump tax cuts. And so from back then, we had a decrease in the headline tax rate from 35% down to 21%. Now, actually, corporations pay lower rates than that, but that's like the headline rate, and that will affect their effective corporate tax as well. And so the proposal is to boost that up to 28%, which is the halfway point. And whether or not they can get something like that through the Senate is a little bit tricky, because you have, on one hand, you have the Republicans and the Democrats, so you have that really even split. But then you have some of the kind of the center Democrats, like the gentleman from West Virginia, who he kind of votes along the middle, and so he's kind of he holds like a lot of power right now, because he can stop the 51 vote Democrat push through for some of these projects. And so he already signaled, for example, that he's not really in favor of a 28% level, that he'd like to see a little bit lower, maybe like 25% or something like that. And so as long as you have that pretty tight split, it's actually kind of challenging to get some of those other things through, because you have that some degree of checks and balances where not everybody's on board with that. And so going forward, they could try to rein in inflation by increasing taxes on, say, capital gains taxes or tax on the upper income levels. That might be one thing they turn to. They could also potentially turn to reducing some of the stimulus that they do. They might feel that they at that point they've done enough, and that now they're starting to get problems with the currency. And so we'll see what happens when they go through that. One thing to keep in mind is that sometimes politicians don't have basically there can be a surprising gap between what the public wants and what politicians are willing to do. An example would be at this point that most Americans now are in favor of making marijuana legal, and yet you still have politicians that are kind of slow to enact that. Same thing for a variety of other issues where you have that disconnect that can actually persist for longer than you'd think it would.
Right.
You'd think that if something was so popular that it'd be a no-brainer for politicians to do it, but for sometimes it's due to money in politics where they're encouraged by their donors not to. Other times it's their own personal beliefs where they kind of push back on things, and so that's something to keep in mind. Is that just because the public wants something doesn't necessarily mean you'll get it, but it really kind of depends on what the zeitgeist is of the time, like what kind of politicians are in power, and how much control they have over the the Senate and the House.
Yeah, that's a great point. So how do you see, or have you given much thought to the kind of end game with, we'll call it the cerveza sickness? And what I mean by that is I don't think there's any disputing that it has economic effects. When you're reducing the capacity, or even in Florida, where I am right now, you've got people that are changing their behavior patterns due to businesses requiring XYZ, and if it's not even if it's not mandatory by state law or county law, something like that, it's changing the economy. So when you're trying to think through, okay, when do we get back to quote unquote normal? Like one thing that I've tried to do personally is I go to Whole Foods all the time, or Trader Joe's, and I try to think to myself, what would need to happen in order for no one to be wearing a mask in this Whole Foods, or for this Whole Foods not to require people to wear a mask, because they're so far the other way. Like again, I'm in Florida right now. There's no state law requiring it, and where I am, there's no county law either. And there hasn't been a county law here since like February. But yet still, when you go to these businesses, they're not just requiring it, they're over the top. I mean, if I just even went to get a salad the other day at the little at the thing, and the gal was just freaking out that I went to grab it without putting gloves on first. Okay, so I mean, have you thought about what it would take to get that to end? Because I do think it affects the economy substantially.
I have thought about it, but that's of course one of those things where if you don't have an edge, it's really hard to predict. Like I don't feel like
Right.
my predictions can be better than most other people.
Right.
So one thing that definitely is done is that what we define as normal is a moving goalpost. It changes over time. And so one thing that's that I think a lot of people have pointed out correctly is that COVID in many ways, cerveza sickness in many ways accelerated the adoption of technology. And so, for example, things like Zoom, as an example, that they were kind of inevitable anyway, but it kind of pulled forward maybe 5 years into 1 year. And so even when you kind of go back, you're not going to go back all the way to where you were. You basically you might take we took like 5 steps forward. We might take like 1 or 2 steps back, and then kind of continue the trend from there. And so there's certain types of jobs where they do want to get back to work, where there's other types of jobs that they realize we can actually do this just as effectively online. We can maybe give people like as part of their compensation, they might have 2 days at home and 3 days on the job, depending on what kind of job they do. And so definitely, I think that's kind of permanently entered the mix in a way, and the different companies, different sectors, different people will kind of figure out what that means for them. Now, going back to behavior, I mean, if you look at the Great Depression, that stuck with people for generation. Where if they lived in abject poverty, they would save every screw they had and every rubber band that they ever got, because you never know when something's going to be useful, and you might have to really make do. They basically didn't have the mindset of abundance because they went through that hardship period, and so that's kind of one of those things where I do think there's going to be very lingering effects with this, because people have gone through this for over a year now. And so even as things increasingly normalize, I think there's going to be a percentage of people that kind of stick to that pattern to an extent. But it's hard for me to predict, a year from now what that's going to look like and what percentage of stores are going to have that approach. But I think it's going to be a non-zero. Yeah.
Yeah, especially when you look at the 1918 and you look at the Spanish flu, and then that was far more devastating from a health standpoint than what we're dealing with now. But yet we had the Roaring '20s. And so, maybe there is light at the end of the tunnel. I'm just trying to kind of use some game theory there. But to your point, we really don't have an edge there at all. So I'm sure right now, everyone that's watching this is thinking, oh my gosh, I've got to go up there and I've got to go load up on gold right now or Bitcoin or something, because we are definitely getting inflation. Because all we've been talking about is inflation and why it's most likely coming, at least consumer price inflation. Let's go over the argument against inflation, though. I want to talk about, specific outcomes that are probable, way above zero, that could happen to where we would see at least asset deflation, and maybe even consumer price disinflation. I hate to say consumer price deflation, because I think that would really take a lot. But what's the counter argument, Lynn?
Yeah, the counter argument, there's a couple of different varieties, and they are ones I've taken into account when it kind of determining how I think this is going to play out as a base case. And so kind of like how in the beginning of the conversation we talked about how 2020 was a year of extremes. We had the biggest economic shock and then the biggest fiscal stimulus in response. So you got that kind of wild fluctuation. The same thing's true for the inflation versus deflation argument. On the deflation side, you have technology is extremely deflationary in a good way, right? So like your phone can now do the things that 10 or 20 devices would do 20 years ago, and so we need kind of fewer things because we've consolidated a lot of stuff into software and just technology in general. We've also had outsourcing for decades, and that has kept costs low for many consumer goods. And so if you look at things like consumer electronics or apparel, they've had a steadily, they've had most cases outright deflation.
Right.
And so that's been offset by the fact that some areas have a pretty high inflation, like mostly things that are service related, like healthcare costs, tuition costs, childcare costs, things like that. Now, housing's been a tricky one because housing prices have gone up a lot, but because mortgage rates have gone down a lot, the actual kind of monthly cost to buy a home has been relatively static. And so that's kind of been a not really been a headwind in the way that some might expect. And so it's kind of been kind of a mixed bag there. And so when you kind of take that full spectrum, we've had these really inflationary areas and very deflationary areas. Also, if you look at demographics and debt levels, because we have an aging, slower growing population, and because we have a lot of debt in the system, those tend to be very deflationary forces. And so the deflationary argument is essentially arguing that some combination of those things are going to overwhelm whatever fiscal responses that policymakers are able to do. And then where that comes from can depend on the person. So for example, you have someone like Jeff Booth, who argues, mainly from the technology standpoint, that technology is going to increase so exponentially that it's really hard for inflationary policies to keep up with it, that they have become increasingly extreme to avoid disinflation. On the other hand, you have someone like Lacey Hunt that really focuses on the debt side of things and argues that as long as there's this much debt in the system, that it's very, very hard to get sustained inflation. Now, the inflationary response to that is that if you do sufficient fiscal stimulus and you literally, basically, send money to people, issue bonds, and have the central bank buy most of those bonds, and therefore directly increase the broad money supply, that if policymakers are willing enough, they can overwhelm those deflationary forces. And if you look back in history, you've never really had an economy collapse from deflation. Eventually, it gets bad enough that they print, and then therefore you get all sorts of history of currencies collapsing because they've overstimulated, because they've countered deflationary forces, and they've had an inflationary outcome. You almost never have a case of really persistent, kind of a disinflationary collapse. The closest thing you'll get is something like Japan, where they fought against the disinflation for 30 years and basically broke even. where you didn't really get disinflation or inflation. But even there, you had, major corporate deleveraging. You had very slow broad money supply growth. I mean, Japan, people often point out Japan's Bank of Japan's balance sheet went up a ton, but their actual broad money supply went up very, very slowly, one of the slowest in the world over the past 20 years. And so when you have a lot of those forces, you can get that kind of balance between inflation and deflation. But if we're seeing now what we're seeing now with the very rapid broad money supply, I think that most inflationists look at that and they think that that's going to overwhelm, at least for a number of years, those disinflationary forces. And so that's kind of the debate that's playing out now. And so the next step is to watch these base effects, which inflationists are going to call that a win, deflationists are going to call that transient, and they're both going to be kind of right. But then the question is, what happens after that? Are we going to go right back to a disinflationary trend, or are the inflation is going to be correct and we're actually going to get sustained shortages, sustained more and more fiscal responses, and if it's going to be enough to kind of keep broad money supply up enough that it counteracts all those trends? And I lean more towards that inflationary camp. That's been my base case for a while, that probably they're going to, quote unquote, print enough to offset those disinflationary forces. But it's by no means certain. It's kind of important to keep watching, especially what's happening with the fiscal variable. That's kind of the most important variable I'm watching as it relates. Because if fiscal steps aside and you're purely relying on bank lending and things like that, then I'd quickly be in the disinflationary camp, along with Lacey Hunt and other people like that. I'd be like, no, you're totally right. We're going to get disinflation. And so that for me, the main variable is fiscal going around the bank lending and just directly increasing broad money supply.
Yeah, I couldn't agree more. And then it again goes from an economic question to a political question. So how on earth does the average Joe and Jane out there have an edge when it comes to figuring out what these crazy politicians are going to do over the next year, the next 5 years, or 10 years when it comes to their fiscal responses?
Well, I think part of it is, being diversified to some extent. And so it's one of those things where if you want to make a ton of money quickly, you want to be concentrated generally. But if you want to, make money slowly or preserve wealth you have, then you want to be sufficiently diversified to avoid surprises. And so one way I've approached it is saying, okay, so I'm not going to try to predict the exact inflation levels we're going to get. I'm going to monitor it over time and adjust accordingly based on what's happening with the fiscal situation. So I say, okay, here's my basic case. My base case is that I think they're going to basically do enough stimulus, and that we're probably going to get some measure of higher inflation than we've had, say, over the past decade. We're already seeing it in monetary inflation and asset price inflation. So the question is whether that goes into consumer price inflation or not. And I think it is, and that it will. But I say, okay, let's monitor that to see if that holds up. If they raise taxes enough to offset some of their spending, and therefore they stop kind of running these really big deficits, and they money supply stops going up at a pretty fast rate, then I say, okay, this might be a little lower than I thought now. On the other hand, if they keep doing, say, another large round of stimulus, but they don't really increase taxes, then I say, okay, now this is kind of keeping up with the trend of higher and higher broad money supply. And so I'm kind of watching that over time to see how that plays out. And then meanwhile, I say, okay, certain equity markets or sectors are overvalued. Other ones are still reasonably cheap. So I can kind of, tilt my portfolio in sectors or companies or areas that are not as expensive as others. And then I can also look at different commodities and say, what is oversold or what is out of favor. So you have gold, you have copper, you have silver, you have uranium, you have Bitcoin, you have real estate markets. You have all these different levers, all these different areas you can go to find whichever ones are kind of not bid up to maybe the extent that some other ones are, relative to what their long run potential is. And so I kind of just have that very diversified portfolio that generally tilts towards a reflationary portfolio.
Yeah. What's funny is the people who don't like that diversification, they say, well, put all your eggs in one basket, but just watch it very closely. And it's almost like you're saying, okay, what I want to do is I want to diversify my portfolio based on this macro view I have, or macro base case. But so I want a diversified portfolio, but I want to watch that macro base case very, very closely.
Exactly.
Yeah.
If I were to say become more deflationary for whatever reason, then I would make changes. I'd say, okay, we actually do want some treasuries, for example. rather than being very kind of underweight treasuries, I might say, okay, if I actually think they're going to say stop fiscal stimulus, we're going to get political gridlock, and we're going to kind of roll over into kind of a really persistent disinflation, I'd say, well, maybe I'll take some of my reflationary chips off the table and push those more into bonds.
Yeah.
But because I have the current outlook I have with my current base case, I'm underweight the more deflationary assets and overweight kind of an array of more reflationary assets.
Yeah, I don't think there's been a time. I mean, I'm a professional investor by any stretch, and I've only been doing it since 2012. But it seems to me like there's never been a time where macro is more important. And you got, even if you're a tops up or a bottoms up type of person, you've got to have at least a view of the macro environment, I think, or you're really, you know what it seems to me? It seems to me like you're a real estate investor in 2006, and you can be the best real estate investor and know every single street in your neighborhood, and you know where the apartment buildings are, you know what the comps are, you know absolutely everything. But yet, if you don't understand what's happening with the mortgage market, or if you don't see what could happen in 2008, then no matter how good you are from a bottoms up approach, you're going to get absolutely smoked. And it seems like the same thing right now. So for the average person out there, let's talk about your views on just broad S&P, broad bonds. Let's keep it simple, and then let's go over gold and Bitcoin.
Sure. And so, going back to your point, my early investing years were kind of focused on the Buffett style investing, like finding good companies and wanting to hold them for a long time,
Right.
and not really focusing too much on the macro situation. But as we've had so much, going back basically to being at the end of a long-term debt cycle, to being in an environment that you have to go back like 50 or 100 years to kind of find similar situations. That's where the individual company can matter somewhat less than these big macro forces. As an example, one of the reasons I bought bank stocks in 2020 of all things is I was like, so if you just kind of exclude the macro situation, you say, okay, bank stocks, they haven't performed very well, and now they're in a recession and people are losing their jobs, and therefore banks can't do very well, right? But then you say, okay, but if everyone gets checks and they don't have these insolvency events, and bank deposits are going to go up a ton, and you're getting a steepening yield curve, well, then suddenly bank stocks look reasonably good in that environment. And so that's a case where if you weren't factoring in the macro environment, you can't possibly determine how those bank stocks are going to perform.
Yeah.
Same thing if you're investing in healthcare stocks, you have to keep a watch out for regulatory changes. If you're in, basically whatever sector you're in, you have to really kind of keep in mind some of these really big macro forces that are happening. And so when I look at the S&P 500, I'm not super enthused about that index. I like the equal weight version of the S&P 500 a little bit more than the market weight version. There are simple ETFs that you can do to get exposure to that.
Explain why, Lynn, because I don't know that most people understand the logic there.
Yeah, so if you look at the normal market weight S&P 500, the top 5 or 10 companies account for a pretty significant percentage of that 500 company index, because Apple, for example, is weighted like 20 times more heavily than American Express or whatever the number is, because it's based on market capitalization. And so if you were bullish about those top companies, well then you probably would want the market weight version. Whereas if you were you think that there might be more action in, say, the middle of it, and you want kind of that more diversification, well, then the equal weight version gives you access to the same companies, but without that concentration in the big, FANG stocks that are, at this point, I think pretty pricey. I'm also finding that it really kind of depends on the specific company. And so I like that mix of, I use a few ETFs for broad exposure, but then I personally like to go out and buy individual equities. And so I can say, I don't want Apple, but I want Amazon, for example. I don't want this company, but I want that company. And so I try not to have too much of a prediction about what the S&P 500 is going to do, because it's partially going to depend on what happens to the denominator currency. But overall, it is in many ways quite stretched. We're at 200% market cap to GDP, and now we're starting to talk about things like increased corporate taxes, and things like that. That if they were to get enacted, are somewhat of a headwind towards the S&P 500. And so I have to kind of keep track of those macro variables and change my outlook over time. but I'm not super enthused about the S&P 500 at this price level. But at the same time, if you look at the Treasury market, you're not getting a ton of yield for what I'm expecting from broad money supply growth, from consumer price inflation. You're getting effectively a negative real yield, and so that's not a place I really want to be in either. I guess if I had to pick, I'd almost rather be in the S&P 500, for the next 20 years, because at least I'm pretty sure it's not going to go to zero. Whereas if you're holding currency, it's always possible that you could literally lose your entire investment.
Right.
And so between the two, I like equities more than bonds, but I'm not super thrilled about either. When I look at areas that I'm more interested in, it's certain foreign companies or certain specific companies in the U.S. As an example. And so I've been pretty bullish on some things on the more value side of the spectrum, like some of these commodity producers, some of these banks. Now the banks are actually getting a little bit stretched here, but things that are on more the value side of things that are kind of out of favor are things that I've been more bullish on. And then when you look at the precious metal space, gold has had a pretty big correction here, and I pretty much like it from these levels. It's partially going to depend on what happens with real interest rates, and so if bond yields go up faster than inflation, at least as officially reported, because that's what the the paper gold market looks at. If that continues to happen, you could get another low in gold. But overall, I think we've de-risked it a pretty significant amount here, where I like to have that as part of my portfolio. And then with Bitcoin, you have much more volatility there, but I still am, say, constructive for the next 6 months or so, based on where we are in the halving cycle, based on what I'm looking at in terms of on-chain indicators, in terms of supply inflow or outflow from exchanges, and some of the dynamics that are happening there. And so rather than have a concentrated bet on any one thing, I like a mix of things. So I have individual stocks, I have certain ETFs, I like certain regions more than others, and then I incorporate, gold, silver, Bitcoin, commodity producers, things like that. They have that rather diversified mix, but it's generally tilted more towards that reflationary outcome rather than a pure like all-weather portfolio.
Yeah. So one of the things that we talk about all the time in Rebel Capitalist Pro with the members there on the live streams is some of the picks that you have in your own personal portfolio that are overseas. And I think a lot of these companies people most likely will have never heard of unless they're actually a member of the forum. So let's go over like just 3 of your favorite foreign stocks right now.
So as an example, I've been pretty bullish on the Japanese trading companies. And so those are large, kind of partial commodity producers, but also industrial suppliers, and they own some real estate like convenience stores or supermarkets. And so, for example, I've been bullish on Mitsui as one of the examples of a Japanese trading house that has pretty diversified commodity exposure, but that also has that ballast of those more cash flow steady businesses. And you're getting a pretty high dividend yield, you're getting a pretty cheap valuation. And so that's something I'm happy to kind of buy and hold for a 5-year period and see how that plays out. I think that would benefit from the more reflationary trends if some of that thesis plays out. And you're not really, your downside is not super high compared to the upside you could get out of it. Yeah, you're getting paid a pretty substantial dividend yield above the Japanese average, above the U.S. average, to hold it. And so you're not getting explosive growth, but you're getting a diverse mix of businesses that generally benefit from currency devaluation, and it has a global exposure. So it's not just tied to Japan; it's tied to what commodity prices do, what emerging markets do, things like that.
And businesses actually make profit.
Exactly. Yeah.
As crazy as that sounds.
Exactly. Yeah. And then I've been bullish on Sberbank of Russia as an example. It's a bank. They have a positive yield curve. It's historically well run, despite the fact that the Russian government owns a big stake in it. You'd think it'd be poorly run, but it's actually historically been a very well run bank with a very high return on equity, high dividends to shareholders. It's trading at a single digit price to earnings ratio, even though it's been it's held up very well in this environment. And then what's interesting about it is that they actually have a lot of technology bets, because their mobile app is one of the most heavily used in the world. Basically, they have a higher mobile penetration than most other banks around the world. They've adopted technology very well, Basically, their app is almost as popular as some of the social media apps in that country. It's very heavily used, and they've expanded into like cloud computing. They make a lot of little investments, and then sometimes they own a stake in investments. Other times they own the whole thing, and so it's actually you're getting like a bank that's it's paying a high dividend yield. It's growing at a moderate rate. It's very cheap, but then you're getting like almost like a call option on technology over the next 5 to 10 years. And so there is regulatory risk. Like, we could come out and say, Russia and U.S. Tensions increase, and then Americans can't own Russian stocks anymore. There's always tail risks like that. So I would manage the position size. But that's an example of something where, people say, everything's expensive. It's like, well, here's a company with a single-digit price to earnings ratio and actually a pretty stable business. And so that's another, kind of area that I like at the current time.
Yeah. What about if someone's like a U.S. citizen right now, all their expenses are denominated in dollars? What if they're like, okay, Lynn, those sound great, but what's my currency risk?
So at that point, you have basically with all these kind of foreign investments, you do have currency risk. And now with Mitsui & Co., because you're largely tied to commodities, it's maybe a little bit less currency risk than you'd expect. It's basically got some global exposure, so it's not just purely a yen-based trade. Sberbank, being a bank, is very tied to Russia's currency. And so Russia's currency is one where a lot of people are concerned about it because it's volatile, it's tied to energy prices. But if you look at the actual fundamentals of it, Russia has very, very high foreign exchange reserves relative to its broad money supply. They also, they went into the COVID, the cerveza sickness crisis with, a fiscal surplus and a trade surplus. And of course, that was disrupted by their own stimulus efforts and the fact that oil got very cheap. And so, like anyone else, they're going through a period of pain right now. But structurally, they're in decent shape. And so there are issues there. Like you have demographics issues. You generally have a very high wealth concentration there because you have pretty high corruption in Russia. You have all sorts of the list of issues there is endless. But if you look at kind of the fundamentals of the currency, it's actually pretty solid. They have a large amount of foreign exchange reserves, including gold, relative to their broad money supply, and they have positive real interest rates. And so overall, even though it's a volatile currency, it's a currency that I don't mind having exposure to. But another thing that people ask me is I often say that I do think that that many of these foreign indices could do better than the U.S. indices over the next 5 or 10 years. And so they say, why do you have any U.S. stocks at all? Why not just have pure foreign exposure? And that actually partially goes back to your question that, my expenses are denominated in dollars. And so I generally don't want a portfolio that's, say, 100% foreign equities. I want to have that mix. So I say, okay, in the U.S. market, what stocks or sectors do I think are attractive? And I'm happy to buy those. And then, I'm happy to then have a big slice of my portfolio that allocates to all these other bets that are out there. And so that's how I approach it to kind of balance currency risk with, basically diversifying my currency exposure so that I'm not fully tied to the dollar either. So if the dollar weakens, my foreign companies likely do pretty well in dollar terms. And if you were to get those other ones weaken, well, then, I'm still heavily diversified. My U.S. Equities are probably doing pretty well in that environment and things like that.
All right. So one more. What do you think? I mean, I know we've talked about Singapore banks, Luke Oil. I'm sure, is that still one of your favorites, or has that gotten a little more expensive?
It's gotten a little bit expensive, but I'm still long that one with a pretty long-term outlook. I guess instead of giving another Russian pick, I would say, one of the stocks is really out of favor right now is Alibaba of China, because they've had some regulatory issues. They basically people are remembering that is a communist country, and there's all sorts of issues there, and it's actually near the cheap end of its historical price range, and so it's not a company that I want to put a lot of money into, because it's kind of like the Russian issue. Like you could have regulatory issues that prevent you from owning it. Same thing with China. Whenever you're investing in China, you have accounting risk, and you also have basically the risk that one day Americans just can't own some of those companies. Which we actually started to see play out a little bit last year, where there basically was increasing scrutiny on allowing Americans to own Chinese equities. But at the current time, Alibaba is so out of favor, and its fundamentals are still very good. I mean, it's a cloud computing company. It's not very expensive based on its growth rate, and so as a small slice in portfolio, I actually think there's a lot of opportunity there. And so that's, there are cases where I think there are some really good growth stocks out there. They're just not necessarily the apples of the world. They're ones that if for one reason or another are not as heavily favored as some of the popular ones are.
Yeah, so many people think that the only option for investing is just U.S. real estate, U.S. bonds, or U.S. stocks. That's it. There's nothing else in the world that you can buy. And it's, especially with as crazy as it is today, and with as overpriced as some things are, with asset bubble just everywhere, you've got to get outside of the box a little bit. And I think that if you do, you're able to find some opportunities, maybe in places where you haven't thought of looking before. That's the bottom line.
Yeah, that's how I look at it. Is that basically there's dozens of investable markets out there, and then when you diversify that to look at things outside of equities, you have real estate. You have for say dozens of different countries. You have for all those markets, you have stocks, bonds, real estate, commodities, and so the number of overall permutations is very, very high. And so I think that's one of the few areas where you can have an edge as a retail investor over Wall Street is that most Wall Street is siloed, right? So there's someone who, she's a portfolio manager. She can only buy U.S. stocks. There's another, guy who's a commodity investor. You can only buy commodities. But if you're a retail investor, one is that you're not marked to market every quarter, right? So you can have a 3 to 5 year view and not worry about your boss asking about your monthly P&L. And then two, you can say, okay, I want to own this Russian stock. I want to own gold. I want to own Bitcoin. I want to own this American stock. I want to own property in this zip code. You can diversify your portfolio in whatever way makes sense for what you're trying to accomplish.
Yeah, for sure. I talked to Jim Rogers about Turkey. Have you looked into Turkey yet?
It's something I've been keeping an eye on, and so there was a period in 2019 where I was starting to get bullish on it. But then, I backed away from that one and ended up kind of, it's a good thing I did. That's been a challenging market, and so I would like to see a change there in terms of, what their monetary policy is essentially. And that the issue there is that you keep firing central bankers, and the ones that are trying to basically do what Volcker did, where they're saying, okay, I want to try to raise interest rates and try to rein in this currency here, and he just fires them. It's like if Volcker got fired by Carter or Reagan as soon as he started to do his thing, we would have had a very different next 40 years. And so that's what's happening in Turkey, where the central bankers are like, hey, let's raise interest rates, and he gets fired. The next one comes in, and let's raise interest rates, he gets fired. And so it's kind of hard to see how that's going to end. But there are certain things that are very cheap there. I mean, one way that I have exposure there is I own Sandstorm. They're a gold royalty company, and they have a very large project in Turkey, and so they have some jurisdictional risk. They have things like that, and it's also it's still in development. It's still coming online, and so that's an example where some investors might not want to invest in that, but I'm willing to take that risk for that part of the portfolio. Because Turkey is historically a good mining jurisdiction that allows that to go through without much of a hassle, and so that could change if things get extreme enough. And so that's one indirect way of betting on Turkey, but I do think that over time there could be opportunities developed there, because very few people in the world right now want to say, yeah, I want to own Turkey. I want to go buy Turkish assets right now, and that's exactly the time where it actually starts getting interesting if you can find a catalyst to reverse some of this.
Yeah, except for you, me, and Jim Rogers. Because I asked Jim, I said, Jim, have you thought about Turkey lately? He says, a matter of fact, I just put it on my watch list yesterday. So that was about, maybe a week or two ago. So, Lynn, I sincerely appreciate your time. I want to remind everyone that Lynn is one of my partners in Rebel Capitalist Pro, the online investing forum. So if you want to check that out, you can go to georgegammon.com/pro. She is also going to be a speaker via satellite at Rebel Capitalist Live. That's the live event I'm doing in Miami, June 11th through the 13th. If you want to buy tickets for that, you can go to rebelcapitalistlive.com. And Lynn, for the viewers who want to find out more about what you do and your website, where can they go?
So I'm at lynalden.com, and I have a bunch of free content as well as a low-cost paid service for people that want to get into that. And like you point out, I partner with you as well, and so I provide that premium content, to the forum at your website.
Awesome. Lynn, thank you for your time. Can't wait to do it again.
Yep. Thanks for having me.
Hi guys, I'd like to invite each and every one of you to join me in Miami this June 11th through the 13th for Rebel Capitalist Live, the investment conference. And this is not over Zoom. This is face-to-face. I'm bringing a lot of your favorites from the Rebel Capitalist Show to Miami under one roof to speak, to give you the knowledge you need to increase your personal freedom, to become a better investor and make larger returns over the next few years when we have this financial uncertainty that's being caused by the Fed and the government. And finally, it's going to give you an opportunity to really take your understanding of macroeconomics and the world around us to the next level. We've got some incredible speakers lined up that are going to completely blow you away. People like Mike Maloney, Jason Hartman, Ken McElroy, Lynette Zhang, Mark Moss, Brent Johnson, Jeff Snider, just to name a few. The tickets for this event are really going to sell out fast, so make sure you go to Rebel Capitalist Live right now to get all the details and to reserve your spot. We need to come together as a group, as a community, especially after what we dealt with in 2020 and 2021, so we can learn how to build wealth and thrive in a world of out-of-control central banks and big governments. And we need to do this as a group, as a community of fellow rebel capitalists. So don't waste any time. Head over to rebelcapitalistlive.com and I will see you in Miami.